Okay, we are about to get going here. We'll wait just one more second. Let anybody that's a little late to join us hop on, and then we'll get rolling. Okay, I want to introduce myself. I'm Ken Huffman. I'm a CPA with Captive Nation. We manage captive insurance companies. We create and manage captive insurance companies for business owners. It's a great business strategy, but it's important to do them correctly. All right, from the setup to the management, it's absolutely essential. You may have heard a lot about captives are scary. And so we thought, as Halloween is coming up here in a couple of days, we thought we would do one on, all right, why do people think captives are scary? What's the perception out there? And if these things are done correctly, they're great. You may have heard the IRS is going after captives, or they're saying different things about captives. What they are trying to do is eliminate abusive captives. Abusive captives are what they're going after, not legitimate captives. Most of your Fortune 500 companies have captive insurance companies, and they're the best risk management tool that's out there. Again, you just have to go by the guidelines. So we want to go through a checklist of things that a clean captive will have every single time. Okay. And so what I'm going to do is I'm going to share my screen, and we're just going to go over these. And if you have questions, you can put them in the chat feature, and we'll be happy to deal with those as they come along or at the end. So let's get going here. All right. So there are non-negotiable things that you want to make sure you do every single time. All right. Now this checklist, it's fast. Okay. There's a lot of things that are on there, but what we're going to do is going to slowly go by each one. Okay. Bear with me just a minute. Okay. A little technical difficulties, but do not worry. We're professionals here. We can get it going here. All right. There we go. Okay. All right. Okay. So as you can see, there's a lot in this clean captive checklist. We're going to go one by one over each and every single one of them. All right. So all of these are derived from a famous captive case called the Harper case. And when captives, if there's issues with them, the latest court cases, there's 3 different ones, they always reference the Harper case. And so all of the checklists, the clean captive checklist that we developed, is all based upon the Harper case in these 3 things. Okay. Number 1, existence of insurance risk. Number 2, there must be both risk shifting and distribution. And number 3, arrangement was for insurance in the commonly accepted sense. So anytime you form a captive, all 3 of these things have to be addressed. All right. And if they say, oh yeah, we go by all those, right? Trust but verify, right? Ask to see, why is it? How are you meeting each and one of these things? Now, what you'll want to do, this clean captive checklist is going to go through each one. So let's go through the first one. The captive's primary purpose for creation is for risk management. So be careful if somebody comes up and says, hey, I got a great tax shelter for you. Captives are not tax shelters, okay? They are legitimate insurance companies. So if somebody's promoting these as a tax shelters, you're going to want to run, because the primary purpose is for risk management. Does it have a great tax benefit? Yes, it does. It happens to come with it, but it's not the primary purpose of it. It just is a benefit of it. The existence has to be for insurance risk. All right. So you have to have some risk in order to insure that. Now, all businesses have risk, right? All businesses have risk. But it's important that you get that measured, all right? That you get that done, your risk measured by an independent actuary. Arrangement was for insurance in the commonly accepted sense. So if you were to look at it, you just have to always have the mindset of, how does this look like from an insurance standpoint, right? Is this really this whole arrangement for insurance in the commonly accepted sense? Again, notice each one of those. The first one, insurance risk, it's number 1 on the Harper 3-prong test. And this one is number 3 on the 3-prong test. So this is really critically important, because they will make sure that, does it appear that it's for risk management? Because if the owners don't know anything about anything, and they're just like, hey, you know what, this guy told me it was a great tax strategy, it can't be that way, right? They have to understand what your purpose is for risk management. Now, the second thing, proper risk transfer and risk distribution. This is the number 1 problem with captives, is they don't do this part, risk transfer and risk distribution. Risk transfer is easy, okay? You do that all the time whenever you pay for your car insurance, right? You're going to write a check for your car insurance, and you're transferring that risk of a wreck over to the insurance company. It's the same way with captive insurance, right? I am going to have policies that's created by my captive insurance company. I'm going to write a check for those policies. I'm transferring that risk over to my captive insurance company. I just did the risk transfer part. The second part, though, is risk distribution. If I'm just transferring all of my risk to my captive, who's holding all? I'm still holding all the risk. The same owner is still holding all the risk. So we have to distribute our risk. Okay. And the way you do that is participating in really, there's 2 ways to do it. And you'll see that on the screen. Okay. The first one is you can have 12 related companies, locations, 12 different things that is going to distribute risk, so long as the risk is no more than 15% in any one of the entities. Okay, so if you have 12 or more entities, and not one of them has more than 15%, is holding more than 50% of the risk, you're okay. Okay, the service says you're distributing your risk with enough within your 12 entities. That's number 1 rule. We have clients that do that. Okay, but if you don't have that, you got to go to number 2, and you have to participate in a risk distribution fund or a licensed risk pool. And how that works is a portion of your premium is going to go up into a reinsurance aspect. And that's one of the great benefits of risk distribution, is that you're getting reinsurance, so that if something were to happen, you file a claim, you don't have to pull all the money from your captive, you pull it from the reinsurance. So we have clients that are big enough, they have enough locations they have more than 12 locations. And so they don't have to do the reinsurance risk distribution fund. They want to. Why? Because they want that reinsurance aspect of it. So those are your 2 choices. People don't do it. There's been court cases where they pay a premium to their captive and it sits in there. So that captive is holding all the risk. They don't have 12 entities. And so by definition of the Harper case, that's not going to work, because you're not distributing your risk. Again, critically important. What will happen in that situation is that the IRS will look at that and go, now, wait a minute. You're not distributing your risk. They bring in insurance professionals. Yeah, you're not distributing your risk. And then it's not going to be allowed. They're going to say, you do not have a legitimate insurance company. because you're not distributing your risk. So it's absolutely essential that you do this part. Let me show you, give you an example of really how this works, all right? So your premium flow, let's just use the example of $500,000, all right, in your business. What's going to happen is 51%, let's see if I can get my pointer going here. All right, 51% is going into reinsurance, risk distribution fund, licensed risk pool. You can call it a lot of different things, okay? But the bottom line, this is where you're going to get your risk distribution. In it are other people that have captives, okay? Other business owners. It's going to stay up there. 51% of your premium will stay up there for a year, okay? The other 49%, right when you write the premium, goes directly into your captive. It sits in there. Where do we get these percentages? Okay, there's a safe harbor rule that's out there, and you'll find different captive managers may say that it only 30% has to go into the risk distribution pool. The safe harbor is 51%. Okay, don't mess around with it. It's very important. So the 51% is going to go up in there, and it's going to stay in there. After 1 year, what's going to happen is if there's any claims, then this pool pays those claims and everybody gets a little bit of piece of that claim. Okay. Now I can tell you just, it's not dramatic. Okay. It may be 2-3% of the premium. It just varies year to year. You don't know what's going to happen. But so you're going to get a percentage of that claim. What's left then usually after the first quarter then drops down into your captive. So let's look at it from a year to year standpoint. All right. First year, 51% goes up there. 49 goes into my captive. So year one, look, 49% is right in there. On a $500,000 example, 245 is in there. Year two, look, I get the other 51% less whatever claims were assigned. All right, which there will be some claims. Every insurance company has claims, all right? Yours will too, okay? You will definitely have claims. So 51% less whatever claims there were. Now you've got your whole premium in there, less whatever claims, okay? And then look what you also have in year two, 49% of year two premium. So now we have, again, these numbers are just rough. They're just for illustration, 735. Year three, we've got our first year premium in total. Now we have our second year premium in total, right? 49%, 41. And we have the other third year, 49% there. And this goes on and on and on and on. Okay. So that's how the premium flows. Now, claims exist. Okay. Just like I said, every insurance company is going to have claims, and it may be you. Right. So typically the way this works is, let's say you file $1 million claim. Your captive is going to pay the deductible, and it's a high deductible. It's $250,000. I know some of you are like, what? No way. Oh my God. There's a reason for that. Okay. Because you would pay the $250,000. The other $750,000 would come from the reinsurance, the risk distribution pool. So is there a benefit to being in there? Oh, absolutely. A tremendous amount of benefit. One, you're being compliant in distributing your risk, but two, you get this reinsurance aspect. So it's a high deductible because we don't want people hitting the pool all the time. We don't want people hitting that risk distribution fund. That keeps it to where there's not a lot of claims in there. Okay, so the claims are proof that your captive is operating as a real insurance company. The Abercrombie case, they didn't have any claims, no claims for years. And so the service looked at that and was like, you don't have a real insurance company. So when they started looking into them, guess what started happening? Claims started rolling in. Too late. It was too late, right? You have to have a real bona fide insurance company. That's absolutely critical in this deal. The premiums are actuarially supported. Okay, this is another very critical, important part. It needs to be done by a third party, independent actuary, not the captive manager. or their staff. Some captive management companies will do this in-house. That has proven to be a problem. Okay, here's the reason why. Let's say the actuary underwriter in-house looks at a company and says, all right, you've got enough risk, the amount of risk and the premiums for all those policies add up to $1 million. And you go to the business owner and say, okay, all of them added up, all the premiums added up, here's all the policies that are $1 million. And he says, I'm not doing that. If I cannot put in $2 million, I'm not doing this thing. Now there's pressure on the company to say, okay, I guess you can do the 2 million. Well, what's going to happen if the service looks at that? They're going to say, what are you doing? Where's the backup of the 2 million? You only have a backup legitimate risk for 1 million. So why did you put in 2? There's no answer. See, because they did it illegally. And so it'll get unwound. You use a third-party actuary. They determine how much risk you have and what the pricing of the policies is going to be. And then the business owner can decide which ones they want. But they can never go over that limit. That changes every year. Maybe your business is really, really good and it goes up. Now you can put in 1.5. Next year you can put in 2. So it just depends. Or your business drops down. Hey, COVID is hurting a lot of businesses, right? So that may drop down next year. So every year you look at that. You just don't want any collusion under the underwriter, the attorney, manager, and client. Now, the policies have to be comparable on the open market. Okay, that's part of the existence of insurance risk. Number 1 of the Harper case 3-prong test. In other words, if I were to go price this somewhere else, the pricing of the policies would be the same or very similar. Okay. Now, of all of these policies that are in captives are unique. And a lot of them, you're not going to find a commercial insurance company to write them. They just won't do it because they can't determine the risk, right? So a lot of the policies will be more expensive. But if they did, then the pricing would be similar. And then here's another big one. The captive reserve funds are managed properly by the captive manager, okay? This is where people really get in trouble. They will say, you know, got a lot of money in that captive. Hey, can I get a loan out of there? I want to go buy a vacation home in Colorado. Now, I love vacation homes in Colorado, but you can't get the money, loan the money from your captive to you personally to do that. You can have no personal loans in small captives. Definition of a small captive or a micro captive is premiums are less than 2.3 million per year. You cannot take a loan, a personal loan, out of the captive. You can, starting in year 2, start taking qualified dividends out of the captive. That is fine because you will then pay capital gains taxes. Okay. But what some owners do, they put in $1 million in their captive. And I know you hear this from a lot from different, it's not us, we don't ever do that, but other managers will allow that. And it's a terrible idea because it's just, if it ever gets looked at, it's going to get unwound. They'll pull that money out and do financial planning with it, right? It doesn't work. It doesn't work. They'll pull that money out via a loan and do financial planning. Don't do that. Pull it out as a capital gain, a qualified dividend, and you're fine. It's called the circulation. There's no circular cash flow back to the owner. Okay. If they see that there's a circular flow of funds, that's not insurance. Okay. With, State Farm doesn't work like that. No insurance works like that. So it's very important. No illiquid or speculative assets. You can't go buy an office building, right, with the funds that are in the captive. Why? Think about it. What are the funds in there for? It's to pay claims. Well, if you bought a building, what are you going to do? Sell off the first story to pay for a claim? You can't do it. Does that make sense, everybody? So you've got to have it in liquid stuff. So you can invest in Wall Street funds, mutual funds, ETFs, things like that. Okay. Liquid. So that you could sell that if you ever needed to pay for a claim. So critically important that you go through every single one of these checklists. Here's another issue where people get in trouble. We form all of our captives right here in the good old USA. All right. We don't do any offshore captives. And the reason why, they have found the regulators over there are very lenient, very loose in that they'll allow you to do whatever. So if the captive owner went to the regulator and said, hey, I want to pull, 75% of my money out of my captive and do something with it, they'd say, sure, no problem. The problem is you've got two different regulators, right? You've got the regulator who oversees your captive, but then you have the IRS. So these people that do this then go and file the 831B exemption that says I get to elect to exempt my premium income from tax. They file that election, and the problem is their captive is not compliant with the standards. And so that's why it might get unwound. So captives are great, but they have to be operated correctly. And so good oversight is important. And we recommend domestic jurisdictions for your captives only. So great tax benefit, again, not the primary reason why you do it. It's for risk management purposes, but you get a business deduction for the premiums you write. The premiums go over to your captive insurance company. And then you can use the 831B exemption to exempt up to $2.3 million per year. So it's a nice tax benefit. Again, not the primary reason why you would do it, but it is a nice benefit. Our management services, I'll just tell you, it's a turnkey insurance management company. We do everything from looking to see, we do that complimentary. Does this make sense for your company or for one of your clients? We kind of run an analysis. The second stage is a formal underwriting study where we hire, the independent actuary. We hire them. They come up with all the different policies and the pricing for your company or your client. The third is that you form the company. Okay, it's a licensed insurance company. We do that aspect of it, and then it has to be managed. And so we do that aspect as well. Every year, these things have to go through an audit. An independent a CPA audit. They have to have the actuary looking at their premium taxes. So we handle everything from the creation to the management of it. That's what we do, to the accounting of it. So it's really, from a business strategy, it's one of the best business strategies out there. People spend a lifetime building their business, and a captive insurance company can help preserve that company. All right. And it makes them financially stronger. It makes the owner financially stronger because the money that's in that captive can be invested. It's protected. It's creditor proof. All right. And so it's a great business strategy. Again, just has to be done correctly. There's all kind of case law associated with captives. Three of the more popular one is the Avarambi case. They did the target premium, right? There was collusion. Remember I said you need an independent actuary? Wasn't independent. And so there was collusion between the attorney and the actuary and the captive manager, and they had a target premium. In other words, the owner said, hey, look, if I can put in, $1 million, I'm interested in doing this. So the actuary, again, not independent, came up with all kinds of policies that added up to $1 million. You can't do it that way. You can't back into it that way. The risk pool, it was not a true risk pool. And again, there were no claims. They used the money for real estate deals. They went and bought land in Snowflake, Arizona. Okay, what happens if they had a claim? They're not going to be able to sell that land real quick. So the IRS found there's no risk distribution. There was a circular flow of funds. Remember, we said we can't do that. And the court determined that it was not a bona fide insurance company. And so they unwound it. Why? They didn't go through the checklist. They didn't follow the checklist. It's critically important that that's done every single time. Another case, reserve mechanical cakes. Bottom line, the pool was bad. Right? They did not have a risk distribution pool that was good at all. There were no claims in there. That's not reasonable. There's always going to be some claim. And then the last one, the latest one, was the Sidergy case. What's interesting about that one is that How they came up with the premiums was a wild ass guess. Quote, that is in the court documents. That doesn't work, okay? You have to have an independent actuary to set those. The policies were not issued in a timely manner. That's another issue, all right? They're not being properly managed. Why weren't the policy issued? And one of the biggest things is that they had huge life insurance policies inside the captive. Can you have a reasonable life insurance policy inside the captive? Yes. We prefer that you take it out through a qualified dividend and do it outside the captive, but you can have a reasonable one in there. But these guys had two massive ones that said it was like $10 million and for a company that was worth only like $3 million. Does that make sense? No, it doesn't. So you can't do that. So it's critically important that you operate these things correctly. And so all in all, okay, we have a question. What is our question?
All right. Peter is asking, is Puerto Rico considered a secret country?
Yeah, so Puerto Rico, that's a great question. It's in a little bit of state of chaos right now. Okay, I can tell you there's a lot of captives that are having trouble right now there, standing up against courts and then the IRS. It all depends, right? Or if they're operating things correctly. Are they following the checklist? Are they doing proper risk distribution, risk transfer? Are they doing all parts of the three-prong test? If they are, it could be just fine. But more often than not, when we see captives come from Puerto Rico, they're in trouble. They're not doing something correctly. I'm not saying that's overall everybody's screwing up. That's not the case. Certainly there are some that are legitimate, but it's a point of problem. They're really having a lot of trouble. It's very loosely regulated. So that's a great question. So we do not use Puerto Rico, if that tells you anything. We only set them up right here within the states. So any other questions? Anyone? So, hey, great. Hey, y'all, if you have a question, feel free to give me a call. Again, my name's Ken Huffman with Captive Nation. Our phone number is 888-944-5588, or you can email me at ken@Captive Nation. I'm happy to answer any questions that you have offline anytime. So, hey, captives are a great business strategy. I hope you implement them either with yourself or with your clients. Just make sure you follow the Clean Captive checklist. We'll see y'all next time. Thanks for joining us.